Hi, today we're going to look at Chapter 18, Introduction to Evaluating Profitability. Firstly, let's look at analysis of profitability. Analyzing means involving examining the reports in detail to identify changes or differences in performance, either between years or between different businesses. Looking at the example of Google, we have the year 2014 and the year 2013. So if we were to analyze Google's income statement, we can see that between the years, revenue has increased and the income before tax, or the profit before tax, has also increased between 2013 and 2014. Interpreting involves examining the relationships between items in the reports in order to explain the causes and effects of those changes or differences. So, for example, if you have an increase in sales, you might expect an increase in wages because more people are required to work to generate those sales, or working longer hours. Going back to the example of Google, we talked about how revenue increased between the years. We can also see that research and development has increased between 2013 and 2014. That might contribute to the increase in revenue for Google. The cost of revenue also increased between the years. Having a look at these two terminologies, we've looked at profit in a lot of detail. Profit is just a dollar amount calculated by revenues less expenses, whereas profitability is about assessing the firm's capacity or ability to earn profit, usually as compared to a base such as asset, sales, or owner's equity. So for example, if company A has a profit of $1,000 a month and company B has also $1,000 profit for the same month, they're similar businesses, it's difficult to judge which one's doing better because we don't know anything about their assets, we don't know anything about the capital invested. Company A might be a very small store. They only have maybe 2 assistants working there to generate $1,000 profit a month, whereas Company B might be a very large store with 4 stories, over 20 employees, and considering they're using more assets, you would expect them to have a greater profit. So judging by that, we might conclude that Company A is doing better. When we're assessing profitability, there are different tools we can use, such as looking at trends, variances, so we might look at the budgeted versus the actual, benchmarks, and profitability indicators. The benchmarks we'll be looking at will be comparing results between periods, as we talked about, budgeted performance, so what we expect versus what actually happened, and also comparing with the performance of other similar firms, such as looking at industry averages to see how our business compares with other competitors. And that's the end.